Why 2013 was very strong and why I think things are going to be a bit tougher this year is because last year we had the benefits of valuation expansion, so shares became more expensive, margins stayed high, and economic growth recovered somewhat from its earlier troughs. So 2014 has the challenge of not having those tailwinds. We think shares are fair to slightly overpriced in certain circumstances, and if anything, there is a risk to profit margins. We have quite a positive view on the US economy. We think the combination of an improving housing market, cleaned up balance sheet on the banks, job growth is consistently around 200,000 people per month, and the insourcing and competitive advantages we're getting from the shale natural gas revolution, all of those are helping the US economy, and we think will continue to help. Looking outside of the US, Europe, we think at best will stagnate. There's not enough positive momentum drivers to push things up. However, they've taken a lot of the tail risks away. So we think it's a pretty average to unexciting scenario in Europe. China's got a significant amount of challenges ahead in how they rebalance their economy from investment to consumption, and how they deal with their shadow banking system unfolding or unwinding somewhat. So we think China could be the most interesting area in terms of unexpected consequences. Three things that I think will impact the economy, global economy, sentiment and things like that, and they'll impact us in different degrees. Firstly, I think China presents a very big unknown. No country of that size has ever smoothly transitioned from such a fixed asset-based economy to a consumer consumption-led one. So we think that process would be a very bumpy one. We're not overly exposed to that, but we think that could cause a ripple in be it sentiment and in certain asset markets like the commodity markets. Secondly, US profit margins and actually Western Europe and UK as well are very high. Companies are over-earning relative to labour. We think that has to mean revert. That mean reversion at some point, when it does happen, will likely lead to earnings growth being below GDP growth. That could have consequences for valuations and share prices. So we think that that is a risk that might show up sometime this year, and we're very cognizant of that. Lastly, Europe is an unknown as to how long they can keep kicking the can down the road of supporting Southern Europe's banks and governments. They've done a reasonable job so far in just keeping the status quo, but it's an unknown how long they can keep doing that. We believe you have to do three things well to get a better outcome. Better outcomes mean smoother, more consistent, upward trending return profile, keeping most of the ups, less of the down. We don't think you can get there by just buying good companies. We don't think you can get there by just buying good companies when they're cheap. So that's the right company and the right price. But they're both very important, and we focus on both those things. We think you have to add another dimension, which is an insurance type component where you find the right company, a high quality, well managed, quality company when it's cheap, and then you agree to buy it for an insurance premium. And by doing those three things well, you get the shares at a lower price, you get the companies you want to own at the price you want to own them, and you get an income as a component of return that helps smooth out your return profile. You know, Rolls-Royce, the key business in Rolls-Royce is civil aviation. They do not do cars at all. Rolls-Royce has a duopoly with GE in wide-body jets. Now, if you think of the aviation market, the value chain, the worst part is the airline themselves. Capital intensive, very competitive, lucky to make a profit. Then you have the Boeings and Airbus that actually make the frames. Now, if you think about once they sell that, there's not much more value they get from their customers after that. But the engine themselves, that's where the heat is, that's where the energy is, that has the moving parts, that has to be constantly serviced, upgraded, maintained. So if you have a strong position in that industry, that is a very powerful industry structure to be in. And Rolls themselves have a very strong order book going into this change within the industry at the moment, where they're rejuvenating, upgrading planes because to become more fuel efficient. Generally, we find the aggregate demand globally will be quite subdued this year for a combination of reasons of deleveraging, aging demographics, and slow economic growth. So because of that, you need to find companies that are able to grow their earnings in an environment of lackluster demand. And in healthcare, specifically healthcare services in the US, insurers, laboratory companies, things like that, where they can bring costs down because there's a bloated cost base within that industry. So if they can bring efficiencies to the table, they can share a piece of that and benefit from that without spending necessarily going up. So that's why we think healthcare is an interesting space. In the oil sector, much like copper as well, it's a supply-constrained industry. So the price, to a large extent, is dictated by movements in supply, not demand. And because the supply constraints within oil are getting worse and worse on a year-by-year basis, we think that creates a significant support for the oil price. And companies that are able to exploit that gap between cost of production and an elevated oil price will benefit. We think it will be far less exciting than 2013. We think that was an anomalous year. We think from a earnings growth point of view should be okay, if unexciting. Valuations, we think, have a bit of downside bias to them. So putting that together from a market point of view, we would expect on the low end, kind of -5 to +10 would be the likely range. And wouldn't be surprised at either end of that, but would be very surprised if it's significantly outside of that. I think the markets are very well supported by a lack of alternatives, so any significant weakness will be short-lived. But the issues of margin expansion, reaching a limit, valuations getting up there, will also provide a natural limit. Where we're quite optimistic for ourselves and our investors is our process is actually very well designed to deliver amongst that sort of environment.